What is going on, everybody? Happy Monday. I hope you guys are ready for a great show. Typically, when I come on here and talk about topics, I know exactly what I'm talking about. Tonight's not the case. You're not going to hear my voice a lot tonight, but the guy that we have talking to us, he is a professional. He knows what he's talking about, and hopefully we're going to learn some stuff tonight. So real quick, as we're going through the chat, I appreciate everybody I've seen so far. What's up, Emo, Travis, Jay Cruz, Floridian, of course, Mrs. Coach. She's better looking than all you guys. I said Emo, Nick H, what's up, man? Li, what's going on, brother? Michael P, Jason Klein, good to see you. And ignore Nightbot because I didn't turn that off. We're not doing channel reviews tonight. I'll fix that. What's going on, Ash? Good to see you. Dash with Ash in Canada. I need to watch your video. I saw your Instagram story today. I'm interested in that type of content. I'm going to go check that out, so I want to see how that went for you. What's up, Jason? Good to see you, man. Travis Tyler's in the house. What's up, Travis? Roger Sports Talk, go Pack Go. I still have not fixed my Packers sound effects on the Roadcaster. I need to fix that. But what's up, man? Go Pack Go. Rush Young, good to see you. I'm going to fix Nightbot in just a second. And if you're telling, you better not be messing with me, Jay Cruz. I'm not frozen. Get out of here. What's up, brother? All right, guys. So, hey, tonight we are going to talk about a topic that I know very little about. I have always kind of done my own thing. Now I've got a business and things are kind of changing for me. I'm learning how this works, but I got a good friend behind the scenes here that's going to help. So tonight we are going to talk about taxes. We're going to talk about business topics. Should you start a business? How do you do your taxes? All that stuff. I want to make sure real quick before we get too much further. I want to throw this up here just as a disclaimer. So for this stream, the topics discussed in this YouTube live stream are for general informational purposes only. Any topics, information, and advice discussed should not be utilized and is not intended for personal utilization. Since the speaker, John Anderson, nor the host, Ken the Content Coach, do not represent any viewers of this content and therefore is unfamiliar with your specific tax scenarios. All specific questions and tax scenarios should be addressed to the viewer's professional accountant. Furthermore, any legal topics discussed are hypothetical in nature. Once again, none of the topics discussed that may appear to be legal in nature should be construed as legal advice since neither Ken nor John are licensed attorneys. So I want to make sure I put that out there because at the end of the day, your tax situation, everything may be different. I'll let John talk more about that. But these are great topics that you can kind of learn from and then maybe go to your tax professional and see how that works out with your unique situations. So appreciate all you guys. Yeah, if you haven't done so yet, if you don't mind hitting that like button, I appreciate that. What's up, Chris? Bearded Respect, what's up? All right, so let's, without wasting any more of John's time, so John is an accountant in my area. He happens to be my accountant, and he lives here right next to me, just down the road. So he's going to come in and school us a little bit. So let's introduce John. How are you, sir?
Hey, good evening. Thanks for having me on. It's a pleasure to be with you. So if only my background was as cool as your background, then maybe I'd be able to speak a little bit better. But anyways, I just have a bare wall behind me.
Well, that's okay. You're still in the office because what a lot of people don't understand is that once you start your own business, you go from a 9-to-5 to a 24/7. So, you know.
That's right. That's like the definition of insanity, right?
It is. Yes.
That's like the definition of insanity. But thank you for having me on. It's a pleasure. This is my YouTube voyage. I'm a newbie when it comes to YouTube. So I'm looking forward to spend a few minutes with some of your awesome guests and talking about topics that nobody ever really finds interesting.
Right. Well, it's January. Everybody's going to start filing taxes pretty soon. We have some people in the audience that have a business, some that don't. They're mostly content creators on one form or another, some hobby, some, more paid business type creators. So we're kind of covering the full spectrum of the topics we may talk about tonight. So before we go any further, I want to make sure I do say, if you guys have any questions that are related to taxes, business, anything like that, we're going to kind of cover a wide range of topics. At the end of the show, we are going to have a Q&A session, so I will be able to search your questions with that Q colon. I'll be able to bookmark those, so I will make sure we get to those questions. We'll grab some as we go, but some of these topics that we're going to cover, we have a lot to cover. So without any further ado, John, do you want to introduce yourself to the audience?
Yeah, sure. So my name is John Anderson. I'm a CPA here in Elizabethtown, Kentucky, so just right down the street in the same city as Ken and Mel. So I'm privileged to work in a great community and have a practice here in a great community with great clients. I've spent many years in the accounting profession. I've worked both in industry accounting. I've worked in public accounting. I've been CFO and controller, held those types of positions for privately held businesses. Then I've also in my tenure in public accounting, I've worked all the way at the lowliest position of staff accountant. Worked my way up in that regard as well. So I'm actually one of the partners at the firm that I'm currently at, one of the shareholders. We'll get into the vernacular here in a little bit, but basically one of the owners of the practice that I'm at. This is my 6th year with this firm that we have, BAK CPAs and Advisors. So we do all sorts of work. We do a lot of outsourced CFO and controllership type work for companies that are looking for those types of services, where we may come along and partner with businesses that are looking for a firm to provide anywhere from more basic services such as bookkeeping, financial statement preparation, things like that, ranging all the way up to working with companies where we may get into more specialized areas in that CFO and controllership type level, where we do stuff like KPI, key performance indicator analysis. We may do cash forecasting, budget versus actual, trend analysis, things like that. But along with that, and one thing that really feeds into when we're working with those types of business clients is it really lends itself to the ability to be able to have I guess the upper hand, if you will, when it comes to taxes and tax planning and what are taxes looking like. So we do a lot of that work as well. That's kind of a natural fit. It kind of goes hand in hand with that work that we're doing with our business clients that are looking for those types of services. And of course too, we work with just the individuals that need their annual tax filing done. They may not own a business or do anything like that. Engage in all sorts of consulting work and so really do a myriad of different types of things, but really spend a lot of time working with closely held businesses, and engaging in the work that comes along with that. Even the estate and the trust planning side of things that come along with that as well, which is kind of another web, if you will, or another spoke in the wheel that kind of ties itself into when you do own a business. So all sorts of good things.
So what you're saying is you work 3 hours a day and go home.
That's right. So something like that. Maybe on April 16th, right? I can't 16th. This year. Well, and that's one thing. So I saw there was an announcement that came out today. So the past 2 years, and we'll get to our agenda here in a second. So,
absolutely.
But the past 2 years, it's really been a mess, if you will, with taxes and the IRS and state revenue departments, just with all of the COVID nightmare. And it's been a mess with everybody and everything, but accounting has been an absolute nightmare and train wreck. So, the first year that we had COVID, the initial date got extended out as like in July. Then last year it was in May, but I did notice that this year they just made the announcement today that tax day will be back in its normal time slot, although slightly off. It's April 18th instead of April 15th this year. So I guess some return to some sort of normalcy, I guess.
Gotcha. Yeah. What's up, Dan? Good to see you. And yeah, Mel says, no question. Just want to thank John for coming on tonight. Please say hello to the wife and kids from us. Can I wait for the new donut shop? Yeah, we like donuts.
So that's right. Donut shop in my spare time.
Yeah, so for those of you that most of you probably don't know, Mel knows. So John and I actually went to high school together. We didn't really know each other that well in high school, but we knew of each other. John graduated, I think a year before I did.
1 year, 1 year ahead of you.
1 year ahead, and
yep.
He's a mainstay in the community. So a great guy. The donut shop is a new venture he's working on. So we're excited about the donuts, and we love I don't know if you want to talk about that real quick because we love the story with the donut shop.
Right. Yeah, I don't care to. So my wife, Tiffany, and I, so I'm supposed to say hello to Tiffany, who is my wife, and Kinsley and Cade. So, hey, if you all are watching, they may be doing homework or getting baths right now, or maybe they're watching. Right. So if you all are, I will see you all when I get home, and thanks for letting me leave to come back to the office to do this. But like you said, I don't know hardly anybody on here. So our son, Cade, who is 6, Cade has Down syndrome. And so, when we first found out the news, that was like somebody took a Louisville Slugger and absolutely just whopped us in the stomach. That's not what we were expecting. And we all have those moments in life, and we all have those situations in life where they're kind of like what I call game changers, right? They really alter the trajectory of where our lives are at that moment in time and where they may be going in the future. So for us, that most certainly was one, and we had found out that news prenatally. So we had some time to kind of process that, start navigating all the things that came along with that, especially the emotions with that. But over the past few years, so Cade was born in 2015. So not long thereafter, we got to networking with families in our communities whose kids have Down syndrome, and we started meeting all sorts of families. We started meeting families who had 4-year-olds and 5-year-olds and 15-year-olds and 20-year-olds. So just really a wide spectrum. The first thing that ultimately led us to was founding a nonprofit organization here in our community, or really in the kind of the central Kentucky region, the Down Syndrome Association of the Heartland. So that was one great thing that came out of that. But here, more recently, back towards the beginning of 2021, a client of mine and a dear friend, we were talking one day. It was after a meeting, and he's a business client, and he's a lawyer. So a lot of these examples we're going to talk about here in a second actually steal from him. I'll kind of pick on him. I'll explain that here in a second. But nonetheless, we were talking one day about dreams and what do you want to do one day when you're done practicing accounting and practicing law and things like that. And one thing that really Tiffany and I wanted to do was basically start a business of some sort. We didn't know if it was a product-based business, a service-based business, what that would be, but we wanted to start a business that basically gave individuals with both physical and or intellectual disabilities the opportunity to be the face of a business. And we don't even call them disabilities. We really call them special abilities, because if you think about it, there are things that I can't do, and really that's a disability. And there's probably things that you can't do, and we could say that those are disabilities. So we all have things in life that we can't do, though we all have disabilities. But we it wasn't just focused on Down syndrome. So we didn't know what that business would be. Talking with my buddy Brandon, he said, well, that's really interesting. I kind of shared this idea with him, and he said, my wife and I, we were interested or have wanted to start a boutique donut shop. Like, what is a boutique donut shop? Like, you hear about boutique clothing stores, but I didn't know what a boutique donut shop was. So he started explaining like all these craft donuts, like key lime pie donuts and banana pudding donuts and German chocolate cake donuts and all these things. Like, wow, that's really cool. And he's like, well, why don't we just marry these two things together? Because obviously it's got to be the right fit. We can't have some of these individuals out there moving heavy equipment. So it's got to be the right fit, right? So it's got to be something that's doable and workable. But the more we talked about it, the more we thought we would give this a go. So out of those conversations, the business Whole, as in donut hole, HOLE, Lotta Love Donuts, was born. So we will be a full service coffee shop where we'll have all the iced coffees and the mochas and the lattes and all those things, plus these donuts where you've got these. We'll have traditional donuts, but decadent donuts as well, and even a build your own donut concept where people can build their own donut. But we've probably hired somewhere between 30 to 35, almost 40 individuals that have unique or special abilities. We're pushing upwards of 50 employees already. So we're hoping here in the next month or so to get open and really introduce our community and our region to some of the best known people that these people may not know that they're out there. So,
yeah, we're excited about it. And I mean, your family's amazing. I mean, Kate's such a cool little kid. I remember that time that we met. We happened to be there at the same time at the trampoline park, and he kept jumping into the foam block pit. Right. He was having a blast, man. He's fun.
Oh, he is. He's more fun than a barrel full of monkeys.
Right. I'm going to grab this question real quick, and then we'll get to our agenda, because I know Dan, he's got a show at 9, so he's getting ready.
Okay.
He says, how much do you love the new requirements under Section 9674 of the federal stimulus bill that changed the reporting threshold for gig jobs to $600 across the country? And he says sarcasm.
No one loves it, right? So fortunately, we don't have to do a lot of that reporting. I think obviously the frustration is going to fall with so much of this. I guess, before I go too much further, I caught myself. We probably should have thrown a political thing in there as well. Like I'm just talking. I'm not trying to take a political stance one way or the other.
Right. Yeah. Yeah.
Generally speaking, by the nature of the beast, accountants tend to be conservative in nature. So, but that being said, what a train wreck this is going to be, and we actually talked about this before we went on, because you were asking me about income and things like that. And we're going to talk about, what's taxable income, what's non-taxable income, regardless if something gets reported or doesn't get reported. It comes down to the standpoint of when you're talking about what is taxable income versus what is non-taxable income. By definition, in its simplest of forms, everything is taxable income to an individual unless it is specifically excluded by the IRS as not being taxable income. So, that's what they caught the great Al Capone with, was income tax evasion, because he was not reporting all of the income from his illegal activities in the mobs and everything back in the 30s, back in, Chicago, New York, where they had all this mob activity going on in the 20s, 40s, however long that went on. But nonetheless, the fact of whether or not it's reported or not reported, and I know a lot of people out there are going to say, well, the IRS doesn't know I made that $400, so, it was a cash deal. I'm not naive. I understand how it works. I'm not saying that's right or wrong, but, there's so much more, with a lot of this legislation that's being passed currently. It's just really, it's placing a lot of burden on the individual income taxpayers and the businesses. Two, it's placing a large burden on these other companies, the PayPals of the world, the Venmos of the world, things like that, because they're going to be subject to having to do this increased reporting. But then three, it's going to place another burden on the IRS itself. And that's a whole conversation. We could probably spend a whole show on that, just talking about the frustrations. I was on hold with the IRS today for a client from 11:30 Eastern Standard Time to 5 o'clock Eastern Standard Time, and I did not get through. So now we want all this more information, or they want all this additional information because they're going to start policing everything. They can't even answer the phones. So sorry, IRS, if you're watching, but
I'm sure they don't watch my channel
yet. Anyways,
whenever I called to do our tech check, I heard the hold elevator music in the background. So I was like, "Oh, you're on the phone, aren't you?"
That's right. So
all right. So on that, most of us that are in here that do this, most of the way that we exchange money is through PayPal and Venmo and stuff like that. So it's going to be a big change for this audience for sure.
Right.
So, all right. So the first topic we had to talk about was creating an entity versus not. So an entity, John and I had this conversation when I first started thinking about actually starting a business out of this, which I do have now. Ken the Content Coach is an LLC, but John kind of schooled me a little bit on LLCs, S Corp, C Corps, all the different stuff that I don't remember now. I just know I'm an LLC. So John, if somebody was considering starting a business, a actual registered whatever, LLC, S Corp, C Corp, whatever, you want to talk about that a little bit? What kind of stuff should they be thinking about?
Sure. So there's kind of two avenues, if you will, that we have to think about whenever we're thinking about forming an entity, right? Because you may see, like you just said, we've got an LLC set up for you. So if you start looking, if you just start paying any amount of attention to businesses that are out there, right, you can see businesses that end in the letters INC for Inc. You can see businesses that end in LLC. You can see businesses that end in PLLC, PSC. There's a blue million different types of these entity endings, if you will, or I call them like the extensions on the name of a business. There's two things that we always have to kind of think about. We have to think about what is the legal side of things, which is basically the formation of the incorporated company, the limited liability company, the professional services corporation, whatever it may be, the Incs, the PSCs, the LLCs, things like that. That is the legal side of the equation, if you will. There's kind of two sides to this equation. So that's the legal side of the thing. The tax and accounting side of the thing is, how is my entity going to be taxed? Is it going to be taxed as an S corporation? Is it going to be taxed as a partnership? Is it going to be taxed as a single member LLC? Am I going to be taxed as a C corporation? Those are really the four options that we have. So, kind of to the first point there, creating an entity versus not creating an entity. What's the benefit? What's the downfall? Why should I do it? If I create this entity, now I've got to deal with filing stuff with the state Secretary of State. I've got to pay them a fee. I've got to do probably an annual report. I've got to do stuff with the Department of Revenue in Kentucky or wherever state, our viewers are in. There's that side of the equation. Now I've got to deal with this other filing generally with the Internal Revenue Service. So it's just a lot of headache, a lot of expenses. Why fool with it, right? What's the big kicker? And for me, and I think for a lot of attorneys that would advise on this, they're going to say it comes down to legal protection of your personal property, legal protection of your assets, right? I mean, we've all probably seen the truck or the vehicle out on the side of the road somewhere when we're driving somewhere, Ray's Electric or Billy Bob's Landscaping or, Susan's Stitchery or whatever it may be, right?
Right.
These people have come up with a name. It's catchy. It's got the alliteration on there. They slap one of those car magnets made or whatever, slap that bad boy on the side of the car and they are gone, right? And they'll put a telephone number on there. So that's fine and dandy. That is a sole proprietorship in its purest of sense, right? I'm going to start a business. I'm going to sell widgets. I'm going to cut grass. I'm going to sew purses, whatever it is. And I'm in business. I mean, it's as simple as saying I'm in business and bam, I'm in business. I don't have to file anything with any Secretary of State. I don't have to register for a tax ID number with the Internal Revenue Service. None of that stuff. I'm in business. So that's great. That's easy. There's very few reporting requirements. There's very few additional costs that are going to be incurred. All those are pros, right? If you're looking at a, pro versus con type of deal. The downside to that, which I view as a major downside, and this downside far outweighs any cost that are incurred by having professionals done, is what in the world happens if I mess something up, right? We're humans. We make mistakes. Guess what? I'm not perfect. I make mistakes. I make them every day.
Right.
Unfortunately, that's just the nature of being a human being. We make mistakes. Not that we mean to, but it happens. Accidents happen. And unfortunately, we live in such a litigious society that we have people that we will come across and that we do business with and that we engage in activities with, that if something happens and they've been wronged or an accident has happened, they're going to pick up the phone and call 502 888-4444, whatever whatever attorney's got the catchiest number, right? Because all attorneys have catchy numbers like that. But they're going to call the attorney that's got the catchiest number and say, "Hey, Ray's Plumbing, man, they really messed me up. I'm coming after them with, we're going to sue them for this and sue them for that." So that is just a really big downfall of not having some form of legal protection. And when that is the case, not only are you Ray's Plumbing or Susan's Stitchery or whatever it is, they're going to come after whatever business stuff you may have, cash, equipment, inventory, vehicles, whatever it may be. But if you don't have some sort of legal protection and you haven't basically created what's called that corporate veil, then they are going to have an easier chance of really trying to stick it to you. If you've really made somebody mad, if you really cut down the rose bushes that the missus didn't want cut down, or you sowed the wrong thing, they can come after your house. They can come after your personal cars. They can come after your personal bank accounts. I mean, they can really throw it to you. By having an entity of some sort, let's forget about the nuances of should I be an Inc. versus an LLC versus a PSC versus a PLLC. Having some form of protection is going to make it that much harder for that upset individual or that wronged individual or whatever it may be to try to come after those personal things. Can they still try it? Yeah, most certainly. But at the end of the day, it's going to make it harder. So for me personally, I would always, always, always advise, yeah, you may think that your business is going to be small. You may think that your business is going to not really take off. Take the proper steps, consult with an attorney, consult with your CPA or tax professional, and put the proper safeguards in place to make sure that your personal assets and your personal livelihood are protected.
Yeah, for sure. When I decided to actually go the business route, and I'd kind of soon, I don't know if you remember when I first called you, I said, I think I want to start an LLC, but what's the difference in all this? And I talked
Right.
to a few guys in the community here that have been doing this for a while. And I don't know if you remember me saying all that, but
I
one thing that
do.
I found out is that in the state, I don't now, let me clarify, state of Kentucky, obviously I don't know everybody's state and how this all works, but the state of Kentucky, starting an LLC was easier than I thought it was. And because I'm a veteran in the state of Kentucky, it was free. There was no fees whatsoever because it's a veteran-owned business. I was like, yes. So, so it was easy. It was easier than I thought. So, but before I
That's
talked to
right.
you and everything, I was like, I was thinking that it was just going to be this massive issue, and I was like, yeah, I'm not going to do it. But yeah, it's not as
Right.
hard as I thought.
Well, it's not, and there's times when you may want to, in some states may be less friendly than other states. I'm not familiar with every state as well,
Right.
so and there may be certain instances. Sometimes a lot of states, the Secretary of State will have these generic forms that will allow you to be able to kind of get the basics in there and check off the box with what you need to be checked off. There may be certain instances where an attorney may need to be involved, and because you need a certain set of documents drafted, or you want specific pieces of content in documents that are being sent to the Secretary of State when you're creating a business. So, but either way, at least the proper steps were done. I'm glad, I'm glad that you made that decision, because there's just so much that you can put at risk. We had talked about, we were chatting, I know you've got a lot of beard guys on here. So
Right.
it would take me 48 years to grow a beard like yours. So, and probably
Nah.
it still wouldn't look that good. So, but here's the thing, I was using this example and it almost sounded like a bad Roy D. Mercer skit. If anybody's familiar with Roy D. Mercer, not the most family
R.D.
friendly
Mercer.
person, but always has the funniest things that happen. He's got this one episode like where they go and the preacher gets a mink coat for his wife, and it's got like these bed bugs or lice in it or something. The preacher's wife ends up with lice or whatever it is. But I mean, what if somebody was creating these beard products and they sold it, and then George somewhere out in Colorado buys some beard products from Billy over here in Kentucky, and his beard falls off, and his beard is his livelihood, and he makes
Right.
money off YouTube because he's doing all these beard shows and things like that, and then his beard falls off. He's coming back after the dude that sold him the bad beard products, right? Because his
Right.
beard has fallen off, and now he's got to grow his beard back. So, but anyways, so
Yeah,
you
for
have to you have
sure.
to keep me on the you have to keep me on our agenda here. So
No, we're good. We're good. So it's funny because I won't go into details, but Dancy, who's in the chat, he's talked about this on a live stream before. He hasn't given all the details yet because things are still behind the scenes, but he's been through that where somebody tried to come after him. So it all worked out. So, okay, so as far as the different types of entities, LLC, whichever way you decide to go, the
right.
question that most people have, and the question, I don't know if you remember this, but the way I asked you was, how do I save as much money as possible without going to prison? That's that's just the funny way that I worded it, but really, I mean, it's an honest question, right? How do I pay as less tax? What is the best way for me to do this that I'm able to stay legal, pay the tax I'm supposed to, but the least amount possible? So thinking about that, how do these different types of entities, how are they affected and mixed in with tax laws?
Well, so I mean, we could spend a ton of time talking about that. So obviously, you tell me when to hush, and I'm going to
Sure.
try not to get into the weeds too far on that. But there are four primary types of taxable entity structures, if you will. And I kind of ran through them a few minutes ago, but we'll run through those again. So one, we have a C corporation. Two, we have a single member a lot of times it's LLC, and LLC is really the kind of the popular legal vehicle that a lot of people are in. So we'll use single member LLC. The same terminology of disregarded entity applies there. The third type that we have is a sole proprietorship, or an S corporation. And the fourth thing that we have is a partnership. So we've got four kind of broad categories, if you will. The C corporation, those have been around for many, 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 many years. They are entities that actually pay tax at the corporate level. Okay, so what I mean by that is the corporation makes $1 million, right? And then the corporation, they have top line revenue $1 million, and then they may have expenses of $500,000. So then they end up with a taxable profit of $500,000. So what happens is the company itself, ABC Inc. or Ken's Beards Inc. or whatever it is,
Right.
that company is going to stroke the check for the tax on the $500,000. You know, a few years ago when President Trump was in office and there were all these tax law changes that were coming out towards the end of 2017, they went into effect at the beginning of 2018. There was this one thing that kept getting tossed around a lot in the news, and it was talking about, oh, well, we're reducing the corporate tax rates from whatever they are, 30%, 28% to 21%, right? So what that phrase meant, you know, we're reducing the corporate tax rate, that was only talking about C corporations. It had nothing to do with sole proprietorships or single member LLCs or disregarded entities, all those kind of lumped in together. It had absolutely nothing to do with S corporations, and it had absolutely nothing to do with partnerships. So it was purely only applicable to C corporations. And that was really a big deal. They had lowered the tax rates from these astronomically high rates on these C corporations down to a more manageable number. And there was actually a lot of school of thought at the time that was out there. You know, you'd read a lot, or you'd see a lot of discussions going on, or read articles in tax magazines. Should our companies that are out there that are being taxed as S corporations and partnerships, should they be making an election to be taxed not as those types of structures, which we'll get to here in a second, but should they be taxed as C corporations? There was a little bit of that activity that took place, but there wasn't, not nearly. Now that we're a few years in, looking back to 2018 and looking at the statistics of the numbers of types of entity tax returns that have been filed, there wasn't really this cataclysmic shift from S corporations and partnerships back to C corporations because of this lowered tax rate. And the reason why it's the reason I believe why that still didn't happen is the fact that C corporations are taxed ultimately twice. So if you've ever heard the phrase double taxation, really the C corporation tax structure is where that phrase comes from. So not only do companies pay tax on their taxable profits, which is actually different from book profits, but that's kind of outside the scope of the conversation here, but they pay tax once on their taxable profits out of the C corporation. But then when the stockholders of a C corporation take dividend payments out of the C corporation. So think about, like, if you own stocks, if you own like maybe the Cokes of the world, the Googles of the world, big companies like that, typically they will pay a quarterly dividend check, right? Well, private C corporations can pay dividend checks all the same, right? So they can pay those out as well. Well, what happens is now that you're receiving a dividend check out of a C corporation, if you're the owner, not only have you paid tax once on the bottom line profit, but now you're going to have to pay capital gains tax, either short term or long term, on those dividend payments that are coming out at the individual income tax rate. So now you're paying tax on the profits that have already been taxed once. So there wasn't a big shift. So C corporations, and there are reasons why you would use a C corporation. If you were a startup company, maybe you're a tech startup company out in California or in Silicon Valley or somewhere out west or whatever, and you're looking to get different rounds of investing. I'm having a Series A round of investing or a Series B round of investing, things like that. Then actually you might look at being set up or taxed as a C corporation because of some legal benefits that you get from that standpoint. But nonetheless, that's one. I'll move on. Secondly, we have sole proprietorship or the single member LLC or the disregarded entity. All those are kind of the same deal. So
Right.
that actually transpires at the individual income tax return. So C corporation, S corporation, and partnership, we all have kind of what I would call outside business returns that we have to file. The single member LLCs, they are filed actually within your individual income tax return on a business form or one of the business forms that's available in the suite of the individual income tax return. So it goes on a Schedule C. Unless you're doing rental properties as an LLC, then we'd be talking about a Schedule E. But Schedule C, probably for the majority of the viewers that are out here where this would be applicable. So basically what happens in this setup is you are paying ordinary income tax. Let's once again use the example: $100,000, $50,000 of expenses. We've got a taxable profit of $50,000. What you don't get to include in that is whatever money you're taking out of your LLC bank account, and let's talk about that here in a second. But whatever money you're moving out of your business bank account into your personal bank account, that is not a deductible expense for the calculation of the taxable profit in a Schedule C type business. So basically, you're going to pay the ordinary income tax rate on whatever your profit is on that $50,000, say. But then also you're going to be subject to self-employment tax, right? So you're going to have to, since in this setup, you are both the employer and the employee, even though you can't be an employee for W-2 purposes, you get to pay, technically it's on 92.35% of the profit that's in your Schedule C, 15.3% of an additional tax. So that represents both the employer and the employee side of the Social Security tax, and it's also going to represent the 1.45% both sides for Medicare tax, both the employer and the employee side. So that's kind of the general gist of how that works. The other two entities, S corporations and partnerships, those are what we typically call flow through entities. So what in the world does that mean? So what happens is, let's kind of stick with our 100,000, 50,000, 100,000 top line income, $50,000 worth of expenses, taxable profit of $50,000. In both an S corporation and a partnership, what's going to happen is that $50,000 is going to flow out or carry over, if you will, to the individual income tax returns of the shareholders or the owners in an S corporation or the partners, which are the owners in a partnership. It's going to flow over on this form called a K-1, and there's always a federal K-1 and a state K-1 if you're in a state where you have individual income tax. But basically what happens are those taxable profits out of the businesses are apportioned out to the individual owners, and then taxes paid on those profits at the different tax rates of the different owners. So let's say, for example, you and we go into business and we're making widgets, right? They always use widgets in business school. I don't know what a widget is. I've never seen a widget.
I'm in IT. We use widgets all the time.
Okay, well, I don't know what one looks like, or I've never held a widget, but you always sell them in business school. So, so we're selling widgets, right? And so we're an S corporation, and we're 50-50 owners in our S corporation. So what's going to happen, in a really simplistic example, is I'm going to pick up $50,000 or $25,000 of that $50,000 profit as ordinary income, and then you're going to pick up the other 25,000, right? And it flows through, and there's a technical way in which all that gets reported. The cool thing about that is what happens is, while we pay ordinary income tax on those profits in the S corporation, we are not going to pay the self-employment tax like we're going to pay as a single member LLC or a sole proprietorship or whatever it may be, because in an S corporation, you and I are going to have the option or the ability to be able to be employees of that S corporation, unlike we could be in a sole proprietorship, right? So you can't be an employee of your LLC, but you could be an employee of the S corporation, and you could also be the sole owner of that S corporation. So then you get a W-2 wage, and so indirectly, we're kind of mitigating some of those self-employment taxes. The same general concept works in a partnership. We would split that $50,000, $25,000, and $25,000. Partnership tax law is a little bit different from S corporation tax law. It's a little bit more complex. So one of the things would be, if at least one of us were actively involved in our LLC that's taxed as a partnership, more than likely the tax courts and tax law is going to say that one of us has to be a general partner. In a partnership, partners can't be employees of a partnership, but they can have employees. So what happens? We could take what's called guaranteed payments. That's just kind of like it's kind of like a payroll check, but it's not really ran through payroll like it would be for somebody who's working at a job or in an S corporation or whatever. And then those gets reported. We would have potentially some self-employment tax that's going to take place on the partnership side as opposed to the S corporation side. So there are some nuances. Once again, there are reasons why you might want to be a partnership over an S corporation. For example, partnership tax law will give you the availability to be able to stipulate that even though you and I may be 50-50 partners in a partnership, we could actually share in profits differently than we share in losses, differently than what we share in distributions out of the partnership, even though all of those percentages may be different than what our general membership or ownership percentages are in the partnership to begin with. So a partnership allows for a whole lot more flexibility if we're talking about the two flow-through types of entities. What gives us the more of a flexible position from a tax law standpoint be a partnership. S corporation really has to be done pro rata based on the ownership percentages. You can't start slicing and dicing and coming up with, okay, well, we're going to share in profits one way and share in losses another way. It's just based on, in our example, 50-50. We just got to split it 50-50. So That's kind of a high level overview. Obviously, there's more to the tax code than that, so we could spend a lot more time talking, but hopefully that kind of illustrates some of the big differences. And back to your question, which saves me the most money? One answer that both attorneys and accountants love, it's a 2-word answer. It depends. It depends on what the purpose of your business is. So just because one may end up in a different result than another, from a legal standpoint, it may be better or you may be more wise to be taxed a certain way as opposed to a certain way, because there are other down the road or behind the scenes tax implications that could come if you get into, let's say, property distributions. If you have a property distribution out of a partnership, that is taxed differently than a property distribution, meaning a non-cash distribution. So if we have a property distribution of a partnership, it's taxed differently than out of a S corporation. So there may be reasons as to why you need to be set up one way or the other for tax purposes. So we can't always just say what saves me the most money. We have to look at it really from truly a planning standpoint and what makes the most sense in trying to think big picture.
So if we can tailor that to, and we may not be able to, I'm not sure. You'll have to tell me if it's too broad or one size fits all. But most of the people that will see this video are content creators like me. So they're making videos on YouTube. They may be monetized through YouTube, so they're being paid by YouTube ad revenue income that way. Some of them may be receiving payments from companies for reviews. So we're talking digital content that's going to go up on YouTube. For that type of a business, and sort of what I'm doing, content creator coaching. Everything is, I really have no products, but I do have, I've got some merch, but I have no real products that I'm selling to somebody other than my expertise and consulting, right? So that being said, is that still one size two fits all? That didn't make sense. I think you know what I was trying to say.
I know what you was trying to say. So that really, that's a great question. So I think that what that really does is that really narrows it down to one of two entity selections. I would say my choice would be S corporation for those professional type services, and those are most certainly professional type services. Now, can you be a PSC or a PLLC? Some of those designations on the legal side of things are really reserved for what are deemed quote unquote white collar professions. And I think that's so antiquated and outdated, but it'll specifically say in the tax law, architects, lawyers, doctors, accountants, things like that. I think that's malarkey, but nonetheless, there are some stipulations on some of that. Malarkey. That was really a Kentucky type word.
That's a Kentucky word. I don't know. Let me know in the chat how many of you guys have ever heard the word malarkey.
Yeah. There you go. So I haven't said that word in forever, so I don't know why that came out. But nonetheless,
we're in Kentucky.
A bunch of malarkey, right? So, but really, I would say S corporation. And I know, we had the conversation as well, going back more to a simplistic form. If you're not going to have employees and you don't want to fool with payroll and you got all that nonsense going on, then really the other option is going to be that single member LLC or the sole proprietorship or the Schedule C type business. But really, if I'm making the decision or if I'm the one that's engaging in that, in that line of business, I'm a content creator, I'm out there on YouTube and dropping podcasts and doing all of that stuff. I'm doing continuing education classes, all sorts of things like that. If that's me, I'm most certainly looking at the S corporation route. So once again, that may not be the best selection for the audience I don't know, but just kind of what I know about your business and what you've got going on and the success that you're having and where you're growing your business and what you're doing, I would most certainly say for you, the audience, things like that, S corporation.
Okay. We may have to talk about that a little more in the future, you and I, as far as what I'm doing. We talked about all the differences, and I went to LLC for now, but, that's down the road. That may change.
Right.
So real quick,
you can be an LLC taxed as a sole proprietorship, or you can be an LLC taxed as an S corporation. You can actually be an LLC taxed as a partnership. So actually, and I'm glad you said that.
Yeah.
So that's one thing to remember. We have the legal kind of the entity structure type thing, side of the equation. We've got the Inc., the LLC, the PSC, whatever it may be. So if you are a one-person owner and you go and you get a tax ID number from the IRS, by default, the IRS is going to say, oh, you're a single member LLC, and that's what you're going to be. But you can make an election to still be the sole owner and be taxed as an S corporation. There's always a form that has to be filed, or sometimes there's multiple forms that have to be filed, but there's a form that you can file that will allow one person to still be an LLC, but just not be taxed as a single member LLC by default. They can make the election to be taxed as an S corporation.
Gotcha. Something to think about down the road. Yeah, we'll have to talk more about that.
Yep.
So two things real quick, guys in the audience, I appreciate all you guys being here. I've seen a lot of your questions come through. So again, if you do have questions that you want to ask, make sure you put a Q : in front of it. We're going to go back towards the end of the show and do a Q&A. We're going to take all of your questions. So I do see them and I'm saving them. We're going to get to them. Also, John,
I feel like that's a lot of pressure, man. I bet we've got I've got that little chat thing turned up on the side, and I've been seeing like just a ton. I haven't been reading it, but I've seen a ton of comments coming in. So,
oh yeah,
I bet we've got some difficult questions out here. I'm kind of worried.
The questions that I've seen, I have no idea what the answer is. So,
great.
And then now I just want to point out. So this guy's name here, this is Ken, the bearded accountant. He does what you do.
You're right.
He also makes YouTube videos and stuff like that. So yeah, I think he liked my one size fits all comment.
That's right.
So, all right. So let's move on. Let's move forward to part of the reason why I came to you in the first place. I pretty much know why I did this, but I do know that like I was able to register online in Kentucky myself, start my LLC. I could do my own taxes, all this good stuff. But why would we need professionals to do this? I pretty much know, but what would you say to that?
Why do you need I kind of know my limits when it comes to being a handyman at the house. So, if it's much beyond a screwdriver or a hammer or anything like that, it's above my pay grade. and I'm probably going to reach out to a professional. I'm not going to go out there and try to fix the HVAC system if something's messed up with it. I'm not going to try to fix the sink if water is spewing everywhere profusely. I'm just going to shut the water off and get a plumber to come look at it. I think in my industry, there's been, I hate to use this terminology, but I think it really fits. I think there has been a cheapening of my industry to some degree, right? And for a lot of people, it may work, right? There's a lot of people that, they get their husband and wife or whatever it may be. They got a couple jobs, they've got home mortgage interest, and shoot, they don't even take the itemized deduction anymore because they raised the standard deduction so high to like $24,000 for a married couple or whatever it is, 24,400, I think maybe. So it's pretty simple, it's pretty straightforward. They do it themselves, right? But we live in such a do-it-yourself society anymore, I feel like, and I think the accounting profession or the CPA profession or the enrolled agent profession has really been cheapened, if you will, by, hey, go out here and buy this $49 piece of software, throw it on your laptop or log into it, or I guess you create an account now. It's probably on the
Right.
web. It's probably the days of CD-ROMs don't exist anymore. But
Yeah.
nonetheless, you create your account. We're going to ask you a few questions. We're going to type it in and check it out, and here's your refund, right? Or here's what you owe. When you start getting into business stuff and business taxes or tax planning or any of that stuff, it is just extremely complicated. It is just there are thousands and thousands and thousands of pages to the Internal Revenue Code. There are multiple ways to get to different results that are all legal. Maybe there are deductions that you are missing. Maybe there are retirement plans that you don't have in place that you could put in place. What's the better type of retirement plan I could put in place? Which gives me the best bang for my buck? There just becomes a lot of what ifs and a lot of variables out there that for an untrained professional, it's just a lot to navigate. And there's just a lot of ways to make errors. It's just, I'm just a firm believer in if I need a service done by whomever it is, an electrician, a plumber, a content coach, whatever it may be, I'm going to go seek out professional help because I want to trust a professional. And when you start talking about companies and LLCs and inks and write-offs, whatever it may be, you just need professional advice. You need somebody that does that on a high level. You need somebody that does that on a daily level. So I'm just a firm believer in that.
Absolutely. Russ, for me, kind of nailed it right here. If I was a business owner, I surely would have an accountant. Look, all the time that we spend hours up till 2 a.m. working to build this business, the hours that go into edit. I mean, everything that we do, that every business owner does, no matter what that business is, we spend a lot of time building something. I'd hate to lose it because I made mistakes on a form at the end of the year,
Oh, right.
Yeah.
And I understand that we have to pay taxes, right? So I like having nice roads. I like having a fire department. I like having a police department. I like having good schools. I get all that, right? So I understand taxes have to exist, right?
Right.
Because we need basic services to be provided by government. But at the same time, I most certainly do not want to be giving more than what I have to give, right?
Right.
It's not my job to give over and above what I'm legally entitled to have to pay. I'm just want to pay what I'm legally required to pay, right? And so really having that professional consulting come in and say, hey, should I have an SEP retirement plan versus a simple retirement plan versus a 401k retirement plan? Should I even have a retirement plan? Should it be a Roth retirement plan? Should it be a traditional retirement plan? What gives me the biggest bang for my bucks? Can I put my wife on payroll? Can I get her a retirement plan? What are things that we can put in place to protect bottom line or profits that we have generated, keep those dollars in some form or fashion in our pockets and mitigate tax, what we're having to pay out in tax? There's two different things that we can think of when we start talking about when we're having to deal with taxes: tax evasion That is illegal. You can't evade taxes. You're not supposed to evade taxes. That is
Right.
illegal. Tax planning, tax mitigation, that most certainly is a legal thing to engage in, and why you should have a professional to help you do that.
What's up, Jeff? Good to see you. Yeah, for sure. And sometimes that can happen accidentally, right? Just
Right.
because I don't know all this stuff. So I'm with you.
Right.
Obviously I have hired somebody. So, and Ken, the bearded accountant, yeah, last year, perfect example why you need someone like John, even for simple tax returns, tax changes mid-tax season, and elections, especially for low-income taxpayers. TurboTax wasn't catching. Yeah,
Oh, it's and I didn't want to. I won't throw out any specific names or other practices that perform a lot of tax work and generate and crank out a lot of tax returns. But the past 2 years, that was a great point by your viewer there. The past 2 years, it has been almost since the start of COVID. There has been tax law change after tax law change after tax law change. And a lot of it has been right in the middle of when we are trying to engage in doing the work. Pre-COVID, usually you wouldn't see a lot of tax legislation taking place in February, in March, in April. We had, for example, going back to the businesses, we had PPP funding that was coming out to try to help businesses. We had 7A loans, 7B loans from the various government agencies. Some of those were forgivable. Some of them weren't forgivable. Which one should I take? We've had, there's just been a myriad of changes. And that's been one thing that's been difficult in our profession, is trying to keep up. It's difficult trying to keep up with the changes as they are in and of themselves, but throwing that into trying to meet these new deadlines. Oh, well, we got to get this PPP loan forgiven, by this certain deadline. And, oh, well, what's an excludable expense? Or when can we apply for the forgiveness? Or when do we recognize the income as non-taxable income on our S corporation return or our partnership return? It's almost been like for CPAs that do a lot of tax work, it's almost been like tax season nonstop since January of 2020. So there's been deadline changes. So it's, trying to navigate that. If I need legal work done, I am not going to draft that myself. Attorneys feel like they are kind of armchair accountants, and I think accountants kind of feel like they're armchair attorneys, just because those two professions do a lot of work hand in hand with one another. No, I know a lot to be dangerous, especially in corporate law, but I'm not a lawyer. I don't have a JD. I'm not a Juris Doctor. I don't have a law degree. So I can't hold myself out as an attorney, nor do I need to engage in the preparation of those documents. But just, it's so important to seek the advice of a professional in whatever it is. I'm just a firm believer in that.
Yeah, Dole Whip Dad. So Jeff down in Texas, he runs a nonprofit. He said the PPP loans were so insane. They changed so much so often.
Oh, it was. Our nonprofit's eligible. They are eligible. How do we calculate what the amount of the funding is? And then then round 2 of PPP came along, and then they changed what qualified. Now we have additional things. It's just been and then the forgiveness process. Certain banks want documents. We people started forgiving loans. I know we're getting way off in the weeds here, but these businesses started forgiving, trying to turn in their loan applications. Should we hurry up and turn in the loan application? Well, no, because there's talk. This was after the first round of PPP. I was advising clients that had received PPP loans not to rush to get their PPPs forgiven, because there was all this talk about simplified applications coming out and not having to substantiate the numbers, and you could just basically, it was going to be under a certain dollar amount, and they would be automatically forgiven. So, but then that led to increased extensions, and it just drug on. So it's just, it's been a mess for the past 2 years. It'll probably be a mess for this year, but hopefully this year we can get back to some normalcy. But anyways, going back to your question, your overarching question, or one of our bullet points we want to talk about, I'm just a firm believer in connecting with those professionals that can help provide business owners and individuals, hardworking business owners and individuals, the guidance and the services that they need.
Right. There's 3 things I won't do on my own. That's garage door springs, HVAC. Garage door springs will kill you. HVAC and business tax. So thank you, John, for having my back.
Well, there you go.
All right, so the next part is probably what people would be most interested in, and this was where we were talking about income and expenses, right? What
Right.
constitutes income? And again, coming from, I mentioned this to you, coming from the perspective of what most of us in the audience and me are doing, which is content creation, which you had a very simple answer for that, and then expenses. So things like home office studio, things like that. We can take it one by one, but let's talk about income and expenses. So the first one, income. You said that was very simple.
That is a simple answer. If anybody out there is looking for some excellent light reading, this I'm joking, but excellent light reading, there is a 42-page document that the IRS puts out, and it talks about taxable and non-taxable income. It is publication 525. You can Google it. You can go to it. You can Bing it, whatever search engines people use, and you can pull up this publication. There's a blue million publications that the IRS puts out, but basically taxable and non-taxable income, and it's a 42-page document that goes through and talks about what are certain things that are taxable, what are certain things that are non-taxable. It sounds goofy almost, and it sounds silly, but basically the simplest way to think about taxable income is to say that the IRS says that everything is taxable income in nature unless it is specifically excluded from taxable income in nature. So it's not like we start off with this big list of what are things that are not taxable income and we back into what is taxable income. It's basically everything is taxable unless we tell you it's not taxable.
Right. I mean, and for us, we kind of know, like, me and Mel are both VA veterans. We receive VA. That
Right.
is, we know
Right.
that's non-taxable, but that's only because we've
Right.
been dealing with it for a while. But
Right, right.
yeah,
I'm kind of I'm kind of more in the lines of I got this commission check from this company, or I got this revenue sharing cut from this company because I did reviews for them, whatever it may be. The IRS is going to say, look, you made money, and especially you're making money in a business. You most certainly need to think of that income as taxable income, unless you can go to a code section in the Internal Revenue Code and say that that is non-taxable income.
I'm curious to see how. I mean, I kind of
And
feel
and,
like I
and
know.
we'll take. Go ahead. I'm sorry.
No, go ahead, John.
Oh, I was going to say, and we kind of have to take that one step farther. And we were kind of dancing around that at the beginning of the show when we first came on. What is, it didn't get reported versus it got reported, right? So I have never found, and it may be out there. So if somebody has ever seen it, please point me in that direction. But I don't think the verbiage exists anywhere that says, okay, well, you made $1,000 doing this job for whoever it was, but it was paid in cash. So it didn't get reported on a 1099 dash NEC, which is like the new form that came out last year for non-employee compensation. So if you get a 1099 or a 1099 miscellaneous income or anything like that. So just because it didn't get reported, you don't have to report it on your taxes, but it falls in the classification of taxable income. So the IRS will say you're still supposed to report it, even though it didn't get reported to us. That's where a lot of the crackdown is going to be coming. Where we were talking about a little bit earlier, the outreach and the increased oversight of the PayPal's of the world, the Venmos of the world, things like
Right.
that. So there will be a whole lot more reporting that's going on. There was talk in some of this legislation that was trying to be passed last year talking about the IRS wanted access to bank accounts to be able to monitor transactions greater than $600. There is absolutely no way in the world that the IRS could data mine all of that data to say, oh, here's a $600 deposit by Ken. That must be income. Oh, well, guess what? Well, we can't match that up now on his tax return because we're missing $600. Oh, there's another $600. Oh, there's another $600. We might as well just audit Ken. I think that's one thing that we're going to see a lot of in the near future is if the IRS, and this is one thing that they are pushing for, the IRS commissioner has really been pushing for a lot of increased funding, like to the tune of 80 billion with a B dollars. A lot of that they want to go towards increasing audit staff. I will give them some grace and mercy and say, hey, we need to give a little bit more funding to the IRS because I was on hold with them for like 5 hours today and they didn't pick up the phone. So let's get some people to answer the phones. But I think there is going to be a ton of increased audits that come along if they get any sort of increased funding. If they get 40 billion of increased funding, they get 20 billion. You are going to start to see small businesses be audited a whole lot more. You're going to see individuals be audited a whole lot more. So we can kind of broaden the scope of the conversation there, not just business owners, but if you're a couple making $75,000, $80,000 a year, and we start getting that type of increased funding to the IRS, you better doggone believe that there's going to be increased audits coming along for a lot of people.
I'm so glad that I know you. I mean, I really mean that. I really mean that because I don't know what I'm doing. So, okay. So expenses. Now, expenses, right? When we talk about expenses, we have things like our home office, right? Like where I'm sitting right now, this is what I use for this purpose. This room is specifically made for what I'm doing right now. So there's some people that travel. There's one person for sure that I know that's going to travel throughout this year and do some shows on the road. He's a full-time content creator. So things like that, even down to the level of buying beard products to review them. When we talk about expenses, what things do we need to think about?
Man, that is a loaded question. That is another episode in and of itself. So we'll try to condense that down and unpack some very high level points on that. So one way that you can think about that is if you incur an expense that is basically, and I'm kind of paraphrasing this here, but ordinary and necessary for the generation of the income that you made, then you probably have a business expense. Now, what I didn't say is everybody needs to go out and buy a Tesla or a Land Rover or a 4Runner or whatever it is because we got to have a brand new stinking auto because we're making some money over here. Now, if you want to do that, are you entitled to do that? Absolutely. Then you get into specifically talking about autos. Well, do I engage in the actual method of taking my auto expenses, or do I engage in the standard method of taking my auto expenses? So there's even two methods depending upon what type of taxing structure you are: C corporation, sole proprietorship, S corporation, or partnership. So depending upon what type of entity structure you are, we could be talking about two different ways we could be dealing with auto expenses. The same goes for home office. If I'm a partnership, can I really have a home office? Well, by definition, you'd even have to have two or more people or entity types to be a partnership. So let's talk about S corporation. So a lot of people out there may not have partners. S corporation, am I allowed to have a home office in my S corporation? Probably not. But am I allowed to have that in a sole proprietorship? Most certainly you are. Then again, don't you love the names that accountants must have come up with these names for these different methods? Because just like the auto, we have the actual method and the standard method. For the home office deduction, we have the actual method, which actually was the only way that you could do that for many, many, many years, up until about 6-7 years ago, I think, when they came out with a simplified version or a safe harbor provision that was a little bit safer or simpler method for people to take a home office deduction. So you start talking about these expenses: auto, home office. One, we have to look at how are we set up from a taxing standpoint, but then two, which way are we going to go? We've got multiple choices on taking expenses. Let's talk about the cars for a second. Okay. We'll talk about that. So, let's say you're a sole proprietorship or a single member LLC, whatever it is. Those are same things. You can take the actual method or you can take the standard method. So what the standard method basically does is says, okay, My home is my office, right? Your home, your studio in your home is your office, right? But you start going out and you're meeting with a bunch of different businesses here. You're meeting with law firms, and you're meeting with accounting firms, and you're meeting with doctors' offices, because they've caught on to who you are, and they want you to do a lot of content creation for them, and they want to learn how to do that content creation. So you're driving from your home to this doctor's office, or to this attorney's office, or to this accountant's office, whatever it may be. Then you basically, under the standard method, get to say, okay, look, I drove X number of miles. Here's what the IRS rate is. The IRS publishes a mileage rate. Sometimes they'll change it maybe quarterly. That's pretty rare. Sometimes they'll do a mid-year, but at least once a year they will update it. So basically you say, okay, I'm going to take my mileage times the mileage rate, and I get this benefit of this expense. If I drove 10,000 miles in a year and the mileage rate was 50 cents a mile, then you're going to get an expense of $5,000 as a benefit on that sole proprietorship or that single member LLC return that you file. Conversely, if you have a car that is in your business or for your business, then you're talking about, okay, well, now I get to depreciate the value of that car. I get to actually deduct the actual auto expenses that I incur. So you're buying gas, you're getting your tires changed, you're getting oil changes, you had to buy new windshield wiper blades, you had to put a new sound system. I mean, that may be going a little far, but you get the picture. So, but the first thing that you have to do is you have to say, okay, well, what percentage of the time am I using this vehicle for my business? Am I using it 100% of the time for my business? And that's basically all I'm using this car for. Am I using it 50% of the time, 75% of the time, 5% of the time, whatever it is? Then you have to say, okay, well, what were my total expenses if I'm engaged in the actual method? I've got my auto insurance. I've got my gas, all those things, right? If we're using so what happens, you pay for those expenses out of your business account. And then what happens for tax purposes, not book purposes, but for tax purposes, then you get to take the expenses times the percentage rate that you say that your vehicle is for your business use. So if you had, let's say, $20,000 of auto expenses under the actual method, and you said you used your vehicle 50% of the time for business, then you would end up with a $10,000 deduction. So that's, for simplicity's sake, that's kind of how the two amounts work. So
now the deductions, I think what Nick may be saying here, the standard versus itemized, this is separate from itemized deductions.
Correct. Right. So I think what Nick is talking about there is that the itemized versus standard deduction, that's just a deduction that everybody gets on their individual income tax return, regardless if you own a business or not. So what we're talking about is kind of the specific methodology, and that could be utilized if we're talking about right now a sole proprietorship or a single member LLC. In the auto expenses, do we do the actual expenses versus the standard method, not the standard deduction, where we basically say it's like 12,002, I think 12,004 for a single taxpayer. It's 24,2, 24,4. They inflation adjust that every year. That's just a deduction that you get standard against all of your taxable or your income that you have as an above the line deduction. That doesn't have anything to do with business taxes necessarily.
Right. Let's cover one more.
Yeah, go ahead,
John.
No, I was going to say, like beard products, that was one thing we had talked about, right? So like, if somebody's out there doing reviews on beard products, but they've got to buy, maybe it's at a discounted rate or a discounted fee, but that person's got to go buy the beard product in order to be able to review it. I know that's probably not really how that works in real life, but
it is for most. Yeah.
Oh, is it? Okay, there you go. So what happens is, in order for the reviewer to generate income based off the fact that they're reviewing these products, if they have to acquire the products in order to generate the revenue, then that is most certainly going to be a legit business expense. If you don't if you don't purchase the product, how are you going to review it? And if you can't review it, how are you going to make income on it? So it's most certainly a legit expense. I mean, I think you can remove beard product and insert whatever, but generally speaking, if you have to incur an expense to be able to generate revenue, or you have just standard office expenses, you got a home office, even I have an office at my house. Our firm is not a sole proprietorship, obviously, but if I'm operating at my house and I'm working at home, I've got office expenses at home, so I'm treating those as office expenses. So it's just really being smart about making sure you're not overlooking anything, and if it's a logical expense that you have to incur in order to generate revenue, then more than likely it is going to fall into the category of a business expense.
If we can break that down even further just for a second. So when it comes to
Sure.
YouTube, there comes a point where you become monetized on YouTube, but for creators starting out, they're not yet monetized. They're creating videos. They're not receiving income from YouTube or anybody else, but they're buying products to review, right? So they're not making any money. They're working towards that, and eventually down the road they will, YouTube is a grind. Hopefully at one point they get there to where they are making money. But for those that are starting out buying products, not making any money yet, does that change that at all?
So yes and no. So let's use the example of a farmer. Okay. I'm going to bring farmers into the fold for a second, right?
Jay Cruz will like that.
Huh?
Jay Cruz will like that. He always says,
there you go. All right, Jay Cruz. We're bringing farmers in if you're still on. So here we go. And I want to use a specific type of farmer, okay? Let's talk about tree farmers, okay? So farmers that basically grow trees in order to generate timber that can be sold, at market. Unless a farmer purchases a piece of land or farmland that has mature trees on them to begin with, more than likely they're going to have to buy trees, and they're going to have to plant those trees, and they're going to have a period of time there where those trees are going to have to grow and mature and get healthy and strong in order to be able to harvest the trees for lumber and thus generate revenue. Right now, I'm not equating timber farmers with maybe the content creators. Okay. So we're the two different categories, but I'm using the tree farmer as an illustration, right? So You're right. It takes time. It takes effort. It takes money. It takes an investment to be able to get to the point where you're monetizing or generating revenue in this line of work, in this industry, right? So we have to think about, there are going to be expenses that are going to be incurred. And initially, guess who is probably going to be funding the expenses? The taxpayers, the business owners. So they are going to incur expenses while they are building their product. Now, the IRS has this rule. They call it the hobby loss rule, right? So the IRS isn't stupid. They're frustrating to deal with, but not stupid. So what will happen is there's this goofy rule out there. It says, okay, guess what? You have 1, 2, 3 years to make some money, or for the IRS to say, hey, guess what? You got a legit business. So I think that's so stupid, right? Because what if it takes you a 4th year to really get to where you're monetizing your YouTube content or your content in general, podcast, whatever it may be. Right. So what they can say is, okay, you had loss in year 1, loss in year 2, loss in year 3, 0 income year 1, 0 income in year 2, maybe a little income in year 3. So after the 3rd year, the IRS has the right to come in here and say, oh, guess what, Ken? We think you are a hobby. This isn't real. You're not really making a real run at this. You're just saying that you're in business so you can buy a bunch of junk, write it off your taxes, decrease your taxable income, thus decrease the amount of income tax that you have to pay. You're getting stuff in the meantime, and we're getting less money. So guess what? You're a hobby. You're not really a business. And you're like The heck I'm not, man. I'm out here working 20 hours a day. I'm doing this as a second thing. I'm really trying to get this thing off the ground. So
Right.
what that it took me 5 years? Well, what the hobby loss rule says is that basically after the third year, the IRS can basically say, guess what? You're just a hobby. You're not really a business. So we're only going to allow expenses to the degree that you have positive income. So if you have negative, if you have a negative bottom line, or you only have expenses, or you have expenses greater than income, then you don't get the benefit of the loss. Now, whether or not that really happens, I don't know. But now I'll point back to my comment about 10 minutes ago where I said if the IRS starts getting a lot of this increased funding, then that very well could be coming. Knock on wood. And I don't say this as an ad for myself or anything like that. I'm just saying,
Right.
knock on wood, that I only in my career have ever had one audit. Knock on wood again. I'm not pounding on my desk right here as I'm saying that. And I've never seen that situation. It wasn't that situation. I've never seen that situation come up. I've never had a farmer be audited because of losses. And if you know farmers, that is a very costly business. It is a very hard business. And a lot of times farmers will have losses.
Right.
I've never had a Schedule C audit where, there was a loss based on 2, 3, 4, 5 years, and it ended up being a hobby loss. I've never had that. Not saying it doesn't exist. It most certainly exists. It most certainly has happened. But for me, for our viewers out there, obviously they are incurring the expenses, and they are trying to build a brand, a business, a product, a line of whatever it may be, of content advising, of beard products, whatever it may be. It can be a whole host of things. So just making sure you have good records, good documentation, that can help substantiate the position that you're taking when taking those losses, or taking the position when you have expenses greater than income. In the event that it got questioned, the more detail, or the more evidence you have to substantiate your position, the better off you're going to be.
Right. And the only thing that I asked John is, don't tell Mel how much I'm actually spending to do this when that time comes. I'm just kidding, Mel.
Right.
I'm just kidding. She knows. So Tommy says, I was told as long as you show growth, they won't touch you. Is that a good general statement? Is that?
I think that's a general statement. So, I mean, if you have zero income, zero income, zero income, zero income, but you have growth on the expense line, then that's not going to cut it. But, you start off on, year zero, we don't have any income, or maybe even year one. But then we start having some income in year two, and then that goes up in year three, and goes up in year four. If things, you can support that upward trend, if you will, or that positive growth from a top line standpoint. It may not be positive growth from a bottom line standpoint, but from a top line growth standpoint, that's a solid position to take.
Right. Yeah, and he also says here, I hope they never enforce it. Been in business since 2011, and I'm still working on being profitable. And the truth is, for a lot of content creators, this is how long we work to make this happen. I mean, some of the creators that everybody knows, like Think Media, the bigger channels, they've been doing this for years, and that's why they are where they are right now. But it took them a long, long time to get there.
Right. And so once again, that goes back to, let's look here. That was bullet point number 3, I think, that we talked about, or it was topic number 3 on our discussion list.
Right.
Why
right.
do I need professionals if I'm engaged in business? Guess what you don't want to do? I can guarantee you do not want to deal with the IRS in a regard. Not a lot of field audits going on right now, but a lot of correspondence audit, or whatever it may be, or a phone audit. You most certainly do not want to do that. One thing that the IRS is doing right now is they are really trying to push these new platforms and services, web services that are available for taxpayers to have direct communications with the IRS. Oh, well, you can log on and check the status of your account, or if you get a piece of correspondence, you can communicate with us through chat or email or whatever it may be. That is a trap. Do not do that. Do not pass go. Do not collect $200. What you need to do is contact a professional, because what they want to do is get you pigeonholed if you have a mess up, or there's a penalty, or there's an interest charge, or whatever it may be. They want you dealing with them directly, because they know they have a higher chance of succeeding in dealing with you than they do with a skilled professional.
Sounds like a bill collector, right? Is this Ken? Nope. Who are you? So So, and really the truth to all of this, and I don't know what this is ultimately going to look like, and I don't remember the exact figure that I saw a few months ago, but the creator economy, which is still fairly new, I mean, several years old, but it's really starting to boom over the last few years. I think $87 billion is, I think, the figure that I saw. That's the
Right.
creator economy. And the more this grows, I think the more the IRS is going to start tailoring some of this towards that specific economy. So, um, you know, I don't know what that'll look like in the end, but I'm sure it will not be for the benefit of us.
Well, generally speaking, a lot of what the federal and state departments of revenue try to do are for the interest of them and not for the interest of the taxpayers,
Right.
unfortunately.
Tommy, on this one, I'll tell you, before I changed from, Bluegrass Bearded to this, I was trying to change the business name, and I sent a letter like 6 months ago, and I called the IRS. Luckily, I was able just to start a new one because I was changing to an LLC, so I was able just to apply for a new EIN. But, John, I don't know the easiest way to change his address.
There is a form. There's actually a form you can. Well, one, you can do it on the tax return. You can do it on the tax return, depending upon what type of tax return you're filing. But there's actually a form. There's actually a form. I can't remember the number off the top of my head. I'm gonna look it up here real quick. There's two.
Sure.
There's one for a business. 80. What is it here? 8822, and it may be 8822B-B for businesses. It's one of those. There's a form out there that you can use if you're not doing it through the tax return, or you can always write. You can write to the IRS. I don't know if I would advise that because they're like 4 million pieces of mail behind. And about there's one I talked with them it was a week and a half ago maybe. Regarding an S corporation election I had made for a client back in March of 2021. I sent this in on March like 2nd or 3rd of 2021. I called like it was right before New Year's. It's still being processed. They haven't even flagged it yet. And they said they're over a year behind on mail. But you can
Wow.
rest
Yeah.
assured if they think that you owe them money, they needed it yesterday. So
Right. That's the way it all works. Yeah. All right, John. So that was a ton of information. For those of you still here, we are going to go into a Q&A. So we are going to take questions from the audience, anything from any of the last hour and a half of information. We have some questions here already, but again, if you will put Q: in front of your question, that will make sure that I see it. I'm going to do my best to catch everyone. So John, you want to do a Q&A real quick?
I will do my best, and I will qualify this by if I do not know the answer, I will make the commitment to help your audience out, and I will look to get them an answer and get it to you so you can get it to them. Obviously, you'll be able to do that. So if I can't answer a specific question, we will get, the best answer that we can, generally
Sure.
speaking, and get that back to you so you can get that out.
And I know how busy you are too, so whatever that looks like after, I mean, yeah. And also, guys, remember the disclaimer in the beginning. Make sure that any information you run through your own tax preparer or your state, everything could be different for you based on your situation. So, all right. So first we have taxes have changed for 2022 for digital payments. This is talking about the Venmo,
Right.
PayPal stuff. And so we kind of talked about that. I think that, Jason, was that all answered for you? I'm guessing. So one question I have on that, John, so when it says $600, is that $600 per transaction or $600 total?
In total, not per transaction.
Okay.
So, and so also a neat note on that. So basically what's going to happen, I think what's going to happen is there are going to be a lot more depending upon, so like however it is that you are registered with like the Venmos and the PayPals and all of that stuff, right? So depending upon how one you are registered, if it's just your social security number and your individual name, then more than likely you're getting these funds through these sources. You may be getting 1099 forms coming across from them. It may be slower this year. It's probably going to ramp up in the next couple years, but it could be happening this year. But depending upon how you are set up. So for example, if you are an LLC but taxed as an S corporation and you have provided that information to the PayPals, the Venmos of the world, whatever, as far as I know, they should, unless there's something specific in the legislation that I haven't read. Generally speaking, S corporations for professional services like that, are not required to receive a 1099 per the 1099 guidelines that are in existence with the IRS. I don't think that there's been any specific change to that, but there's a possibility it could have, and I just haven't read it.
I'm starring a couple of comments here, so let me go back. Okay, so Tommy has a couple.
Okay.
This one may be a joke. I'm not sure. But my wife Venmos me bill money. Should we? Oh no, it's not. I understand what he's saying. So they basically are sharing money through Venmo to pay bills together. So should they quit doing that? Based on the new.
That's a good question. That was one of the chief complaints about like what's going on here and what's going to happen. That goes back to I'm not saying stop, but I'm also saying don't be surprised if you all get erroneous 1099s that aren't legit, because I mean all you all are doing is just sharing money, but in the absence of context, and context is always key, right? So in the absence of context, if the IRS doesn't know any better and Venmo doesn't know what you're doing, maybe the wife has one business and the husband's a consumer of that business. That headed down the wrong path. But nonetheless, all Venmo or PayPal or those companies are doing, they have to follow the rules that are put forth between them, or set forth to them by the federal government. So if they don't know what those transactions are for, but it meets a certain dollar threshold, then they may have to report it. And people may be getting erroneous 1099s. That goes back to the whole deal about people were screaming up and down. You cannot make banks give information to the IRS on transactions of greater than $600. I mean, information's already filed on transactions that are greater than $10,000. So if you have a $10,000 a penny, the banks have to file what's called a CTR, currency transaction report, that documents that information. But that's like taking that down from $10,000 and a penny to $600. There's no way they could manage that type of information.
Right. I also wonder too, so like with PayPal, you have the options of send money to family and friends or actual service cost. I wonder how that will play into that also. I don't know.
Yeah, I don't know. It's going to be it's going to be unfolding over the next couple of years. Will they get it? Will they get it right the first time? Absolutely not.
So Nick H says, when you get an LLC, does this have to be displayed on business cards or probably anywhere else you're sharing? Is there a requirement for LLC to be displayed?
There's not necessarily. Yeah, I mean, I don't think there's not any sort of tax requirement that I'm aware of. I mean, there could be an estate, but from a federal standpoint, no, that's not a requirement. I mean, you're going to see a lot of people do that because I think, one, for whatever reason, I think subconsciously that gives like the sense of credibility. Hey, that dude's an LLC, or that dude's an Inc., or that dude's a PSC, or whatever it may be. I think it gives this level of professionalism, or it gives this sense of security, or you're dealing with somebody who knows what they're doing. As far as, you would have it probably on your, certain tax documents and filings and things like that, but any sort of specific requirement, I don't, not that I'm aware of.
Okay.
At least
I guess that's
level.
probably more of a legal question there too.
Right.
How do people, and I don't know if I understand the question, but maybe you do. How do people buy trucks over 6,000 pounds and basically use taxes to pay for it in full?
Don't know if I understand the question, but we can walk through it in nature. Okay. We can kind of talk through this, and I don't know if I'm answering the question or not, but so let's say, for example, on December 31st, all these car dealerships have Black Friday specials going on. All right. And so you decide that for my business, I need a brand new GMC Yukon Denali, and it's going to cost me $80,000, and it weighs like 9,000 pounds. So we're going to go to the car dealership. I've got my business, John's Accounting LLC, and I am ready to buy a car for my business, right? And I go to the lot, and miraculously enough, they have 0% financing on the last day of the year. So let's say that, I'm going to buy this car. I'm going to put it in my business name, right? I'm going to put it in my business name. and then all the insurance is going to be paid for out of there. The gas is going to be paid for out of there. I'm using this thing 100% of the time, and I'm going to finance this thing for 0% interest. That's free money. Like, I get to operate off somebody else's money for maybe 60 months or whatever it is, whatever deal they're offering.
Right.
I can really, from a technical standpoint, I could buy that car on December 31st. I could finance it. I can not make the first payment until January or February of the next year. And given the fact that I engaged in that transaction, I could potentially, and I say potentially because we could be looking at income limitations or certain rules and regulations that come into play with depreciation rules. But let's say that all of those are met. I could basically write that whole thing off on December 31st, not have made the first payment for it, and then I can make the payments for it, over the course of the year. So I needed, a business needed a write-off, and that's what they wanted to do. They could engage in that transaction. So even though you're financing a vehicle, you can still write it off, because basically now you can't deduct in future years. You can't deduct the principal payments on those note payments because you got the benefit of the depreciation expense. So it's not like you get a double whammy there. But let's go back to that example and say, oh, well, there was 1% interest on it, but I still don't make the first payment until January of the following year. Then any of those payments that I make in subsequent years, I do get the benefit from a business expense standpoint of deducting the interest expense, just not the principal, not just the principal portions of those payments. But once again, we're talking about examples where we may be fully writing something off. Are we looking at what's called Section 179 depreciation expense? Are we talking about bonus depreciation expense? What are specific state rules? Some state rules follow federal depreciation rules. Some states don't. Kentucky is one that does not follow federal tax rules on depreciation. There's income limitations. So there are a bunch of what ifs there, but that's,
Right.
That's a way that people use that little trick to generate business expense.
So next we have, so Tim, hopefully that answered your question. I wasn't really sure what you were asking, so hopefully that covered it for you. Yeah. Let's see. So we have Russ Young, and I know what he's referring to. He says small batch owners and reviewers meet up to discuss the business. Is this a business expense? And let me set the stage for what it is. Every year in March, there's basically a Disney meetup. They meet at Disney Springs. They don't go to Disney and go to the park and all that, but they meet up, and there's some conversations like this, hang out. Is anything like that actually covered?
Yeah, there most certainly is, and just as I'd referenced a little bit earlier, publication 525 for taxable and non-taxable income, there is actually, imagine this, a publication that talks about travel expenses and things like that. It's actually publication 463 if you get a wild hair and want to go look for that one. But yeah, I mean, if you're conducting business, there are always rules. There are always exceptions to the rules. That's in anything in tax. That's in anything pertaining to do with anything with accounting. But most certainly there are deductions, that are available for travel, for gifts, for car expenses, all sorts of things like that. So most certainly that could potentially be a viable business expense as long as it fell into the correct parameters and whatnot.
Yeah, Tommy says back on the vehicle, even better, you can buy an $80,000 vehicle, negotiate to $65K, do the paperwork for $80,000, they cut you a $15K check. Now you got a SBA and a vehicle at 0%.
There you go, Tommy. Good job.
Tommy's a smart dude.
I'm taking Tommy with me to buy my next car. Tiffany says I don't negotiate car purchases very well.
So my friend Gary, he's the owner of Alley Cat Beard Company. Actually talking about when I traveled to New Jersey, he's one that I was hanging out with.
Oh, okay, cool.
So in his case, he has a full-time job. It's kind of like me. He's got a full-time job running a business on the side. His business is further along than mine right now, but any idea why they have him file as self-employed?
As who has
you may have to
his full-time employer?
I'm not sure. Gary, you may have to clarify. So I know in his case, he has a regular full-time job. He's paid. He works for somebody else, and then he runs a beard company also.
If that's the case, I would venture to say with 99.8% certainty that he should be a W-2 employee from his full-time employer. There are specific rules and guidelines out there on that. So you may want to check those, or I can get some additional information. But more than likely, people, I don't have my staff here; they're not 1099 employees. If an employer has the right to, they provide equipment for their employees. And this is a completely different topic, but, the employer is providing equipment for their employees to do their job, or they tell them that they have to be there at a certain time, or they have the right to inspect the work that is being done by the employees, or there's a whole myriad of tests, kind of their checklists that you can kind of go through. But most certainly, I would say that should be a W-2 situation as far as the income.
He's saying no, the IRS is making a file that way. So, let me read it.
The self-employed, I mean, maybe on the business. I'm not sure if self-employed.
Is it because I don't know, Gary? You may have to. Hey, Gary, I'm going to go to another question. I don't know if you want to elaborate as much as you can. I don't know if it's because it's
or can he shoot you? Can he shoot you a message and you can send it to me later?
Sure, absolutely, yeah.
Okay.
All right, so let's see.
Self-employed may be his side business type deal, which would be like just purely a sole proprietorship, which would be on Schedule C, same as a single member LLC. That piece of it would be self-employed, but his income from is from his employer should be as a W-2.
Yeah. Let's see. He said, talking about when I file taxes, the IRS has me to the self-employed route, even though my income is from my employer because the business has been at a loss. I don't know. Hey, Gary, send me, and we'll chat. Me and Gary talk all the time, so I'll figure out more talking to him just in person, yeah.
Okay.
All right, so let's go. So Travis is asking, and I kind of know what he's saying. What if you are in the process of becoming a reviewer? So he doesn't have a channel yet, hasn't made videos, nothing like that, but are you still able to write products off even though you haven't started yet? I'm guessing I know the answer, but I'm not the professional.
I would say that you need to be able to take the position that you have started, a business. And that doesn't mean that you had to go out and get a tax ID number. That doesn't mean that necessarily you have filed anything with the Secretary of State or gotten tax account numbers with your state Department of Revenue. But I don't think you're going to have a tough argument to make saying, well, I was kind of thinking about it. Yeah. But then like 2 years later, I decided I didn't want to do it, but I still wanted to deduct all those things. That's a much more difficult argument to make in an IRS audit than, yeah, I started on January 1st and I had these expenses this year. But it takes a little bit of time to get to that place where I'm generating revenue. So I think if you're thinking about it, and you probably know that you're not going to, maybe that may become I'm not saying it can't be done. I'm just saying it would be a difficult position to take in an IRS audit.
Yeah, I would say I'd probably at least want to be able to show the IRS, hey, here's my YouTube channel. Here's some videos that I have. Here's where I bought, AlleyCat. Here's my AlleyCat review, so you can see there's something there.
Right. Once again, that kind of goes back to the more that you can substantiate, the more that you can document, the better off you are in the event that it gets questioned.
Okay, so I'm going to run through this one here. Tommy says, also something I don't understand. I've worked hard building my business credit strong enough to be standalone, and now that I have my Paydex score, I don't know what that is, and all my business is classified as road work, there's more. He says, my EIN was started as e-commerce, so now I'm lost how it is now road work. And then he said, I guess maybe his main question, which is the high risk supposedly? Is that IRS or a credit bureau issue?
So
the road work is high risk, and he's asking, is that an IRS issue or a credit bureau issue? Yeah.
I would say that would be I'm looking here. I would say that would probably be a credit bureau issue, maybe. But I'll look into that one a little bit further. That one I'm not for sure off the top of my head.
All right. Now, Nick says, now when you pay yourself a check from your business, is this recommended? And I think this is going to go back to which type of entity are you? Does it matter, et cetera, et cetera. So,
well, if you're generating a loss, it's going to be, one, are you generating a loss before you pay yourself anything? Or two, are you generating a loss because you've paid yourself something? Those are two different scenarios. But if we're talking about if your business is a partnership, then technically you can't be an employee in a partnership. So you couldn't have a payroll check that way. A single member LLC or a sole proprietorship, you can't be an employee, although you can have employees, but you can't be an employee. So you basically can't write yourself a payroll check. Now you can take money out of the business, but that doesn't count as a business deduction. Really, the only two places where you're going to be able to be truly an employee and the owner of the business is either going to be in a C corporation or in an S corporation. If you're thinking about payroll check, meaning the kind of what we think of in the traditional sense of I'm having federal income taxes withheld, state income taxes withheld. If I live in a state that has state income taxes, Social Security and Medicare, those types of things, really an S corporation or a C corporation are going to be the only two entity types that give you that option. Partnership and sole proprietorship, really those monies, you just transfer those monies out.
Right. Okay, so we have two questions left here. One of them's super easy, I'm sure. This one probably is too, but so this applies to a lot of us. Just talking specifically utilities, internet, Wi-Fi, or data deductions. How does that work for online? I mean, so like me, what I'm doing right now, I'm using my internet to conduct business, right? So how does that? What are the rules for that specifically, or I guess generally, because it may be
Well,
different.
it varies from entity type to entity type.
Right.
So that being said, if we're talking about a sole proprietorship or a single member LLC,
Right.
and we start talking about the home office deduction, that is most certainly something that's applicable in that entity structure. I mentioned earlier, we've got two different ways in which we can do that, right? We can either do that under the kind of the safe harbor / simple method, which basically just says, okay, what's the square footage of my area that I use solely and exclusively for my office? And then what's the square footage of my home? And then there's a mathematical computation that takes place and you get this deduction, right? So it just kind of calculates things. The
Right.
actual method, which was the method that had been around for a lot of years prior to just, up until about 5, 6, 7 years ago, when that simplified version came out, was the actual method. So basically what happens is you can have what's called direct expenses and then indirect expenses. A lot of the indirect expenses are going to be things that are applicable not only to the square footage of your home office, but actually applicable to the square footage of your entire house. So utilities, yard maintenance, garbage, water, sewer, gas, electric, your mortgage interest expense, your real estate taxes on your home. All of those things are going to be indirect expenses, right? So we still have to go through the process of calculating what is our square footage. What's our percentage? Is it 250 square feet in a 1,000-foot square house. So now we've got 25% of our expenses, 25% of our living area is utilized for our home office. Then we're going to take the sum of all those expenses and we're going to get to take 25% of the sum of the applicable expenses and treat that as our home office expense or deduction. The rest of the applicable things, such as the mortgage interest and the real estate taxes, would then flow over to Schedule A, which is for itemized deductions. And if you have enough to itemize your deductions, then you would get the 75% piece in this example to count towards your itemized deductions, along with charitable contributions, medical expenses, things like that. You also, a little known fact that people don't really think about when they get into doing the actual method on a home office deduction is you actually have to claim depreciation expense on the square footage of your home that is used solely for your business. So now we have to depreciate a portion of our home. Well, then later on down the road, you go to upgrade houses because the housing market's so great. And you sell your house and you've been depreciating this home office now for 10 years, there's a little thing called depreciation recapture, which means that when you go to actually sell your home, although it's been your primary home and you're probably going to have a home, exclusion on the gain on the sale of your home up to $500,000 if you're married filing jointly, you're going to run into a little issue when you have to add back, you have to calculate a gain on the sale of the portion that was your home office, and you're going to have what's called depreciation recapture, and you actually could have to pay a little bit of tax on that. If you use the simplified method or the safe harbor method, that does not come into play. You could get a better, you may get a better bang for your buck under the actual method over the years, but that could get sucked away to some degree if you have that situation where you sell the home and you have the depreciation recapture. If you use the simplified method, then that doesn't come into play. If we're talking about an S corporation or something like that, you're not going to have a home office deduction in an S corporation. But what you may have is the ability to basically reimburse yourself a portion of the utility bills. So, just like cell phone, you may be using your cell phone for part of your business, maybe 50% of the time, and you all are paying that personally. Then you could really say, you make the argument, hey, I use this for 50% of my business. I'm going to reimburse myself that expense out of my business, out of my S corporation or whatever. You can do the same thing maybe on cable or internet or things like that. Hey, I'm using this for business, so I'm going to do an expense reimbursement. Now, let's say, for example, your daytime employer is paying 100% of your cell phone, then really you can't do that, because then you're going to be getting into a double benefit, if you will, or a double whammy. So you couldn't really do that. But it's just, it kind of goes back to, how is my entity structured? What am I doing? What do my numbers look like? And what can we do from a planning standpoint?
A lot to think about. I can guarantee you I'm going to go back and probably rewatch the stream about 3 or 4 times. And I'll probably
Don't do
have
that.
questions.
It'll put you to sleep.
All right. So the last question that I have saved, I'll check the comments one more time. This one may be easier. Go Bama, or it says go Dogs or go Bama. Also, who's your NFL team? Go Pack, go.
Go, man! Everybody, I feel like everybody in Kentucky is a Bama fan for whatever reason. Can we have go Cats? Is that not an option? I would say go Dogs. I think everybody is a Bama fan. Bama whipped them in the SEC championship game. They whipped them the last time they met in the SEC championship game. Go Dogs. If that person's from Alabama, then roll Tide. Or my buddy Brandon, the guy that we're doing the donut shop with, he is a huge Alabama fan, and he's actually at the championship game tonight. So he's sitting in Indianapolis by himself. His wife and 3 kids are sitting in the hotel room while he's at the game. I said, man, you've got a good wife.
He's
that
the
you
same.
can rope her into that, but.
He's the one that was going to be on with us tonight, right? But you were like, sorry.
Yeah. But then he had to go to the Bama championship game. I would say go Dogs. I'm just rooting for the underdog. Everybody's pulling for Bama, so I think it would be Georgia's, if I remember correctly, Georgia's first title since 1980, and it would be their 3rd championship as opposed to Bama's 19th total championship. The only reason I know that is because I heard it like driving into the office a few minutes ago. It's not like I just know that off the top of my head.
Well, you could have left that part out.
I could have, but that would see. Look, I'm honest. I'm an accountant, right? So, NFL team, I'm ashamed to say, because they got whooped when they shouldn't have yesterday, the Colts. So they got whooped by Jacksonville. If they would have just beaten Jacksonville, they would have been in the playoffs. Instead, they got, I don't know what happened. They face planted on their cleats or something, but now they are out, and everybody is on the Carson Wentz, the Fire Wentz, and or Wirtz, whatever his name is, Carson, whatever. It's not Peyton Manning. So,
yeah. What have you done for me lately? Nothing. You lost the playoffs.
Right. What,
and
we live in such a what have you done for me lately society.
Right.
So hopefully nobody holds that against me. If I need to say go Pack, I know you're obviously a big cheesehead. You all are big cheeseheads, but if I need to say that, so nobody holds
No, look, me. I want everybody to be themselves. Nobody has to say anything they don't want to say. Yeah. But I do believe, if I'm not mistaken, you're a huge University of Kentucky fan, right?
Yes, I will go Cats all day long. I went to the other school in Lexington, Transylvania. So
now that's
just it.
Now that you can't say on my channel. We can't say go Cats on my channel. Come on, man.
No. Okay, I'm sorry.
I'm just kidding.
Okay.
Yeah, so hey, this has been a fantastic conversation. Everybody in the chat, thank you so much for hanging out, for the comments, the questions. Hopefully you got some good information. I know I did. I'm probably going to rewatch a few times, so you guys may have to also. So thanks for being here tonight. John, thank you so much for taking this
Hey,
time. And
listen, it was my pleasure. It was my honor. Thank you so much for allowing me the space and the opportunity just to come hang out and chat and meet some cool people. It seems like you've got some great friends here. You've built a great community. You've done a wonderful job, and it was fun to hang out for a while.
there's a lot of good people here, and I appreciate every single one of them. But seriously, I appreciate your time, and tell Tiffany and the kids that we thank you, because you very well could have been there with them, and just thank you for your time. I know how that time is, so I appreciate it.
It was my pleasure. My pleasure.
For those that may have came in, a little bit after, do you want to just quickly kind of reintroduce yourself one more time on the way out?
Yeah, my name's John Anderson, CPA here in Elizabethtown, Kentucky. So I'm a partner with shareholder with BAK CPAs and Advisors. Engage in a lot of business tax and consulting advisory services for businesses of all size. So businesses large and businesses small. One thing that's so important, and we didn't talk about this from the get-go, but as much as you can, I guess, air quote, get it right from the get-go, the easier it is, instead of getting 5 years down the road and having to try to unwind a ball of wax. So regardless of where you were at or what you were thinking about doing, I would implore you to most certainly make sure that you are working with trusted advisors. I tell everybody all the time, if you're going to be in business, it's important to have a great insurance agent. It's important to have a great attorney. It's important to have, great people, a great banker, great people that you can surround yourself with.
Yeah, and I definitely am glad that I have you as my accountant. I trust you completely with this stuff. I mean, look, I don't read about tax stuff until about the first part of March as I'm getting ready to do mine. So I'm glad that I got you in my corner now.
Well, thank you. I appreciate that.
Yep. So everybody in the audience, again, thank you so much for being here tonight. Again, you can find me, my website, kenthecontentcoach.com, email Ken at kenthecontentcoach.com. Social media will be found in the description of this video and every other video on the channel. So once again, thank you guys so much for being here. As always, until next time, take care of yourselves, take care of each other. Just hit record. See you guys later. Later, John.
See ya.